This video is neither a solicitation nor an offer to buy, sell stocks, options, futures, or any securities. The video and all contents are for educational research purposes only. Please get the advice of a licensed financial advisor before investing your money in any financial instrument. Hello, swing traders. What I'm going to do is right click on a 41 strike price and go to covered call. Basically, the covered call is purchasing 100 shares of a stock and selling one call contract. Go over to the risk profile, and the white line is the profit potential. The white line is where you would currently be at. Now, the max profit potential right here, the green line is the max profit potential. And if you look at the bottom left of the graph, you'll see 251. That's the max profit that you would make. That's because if you purchase the stock at $41.46, it got called away from you at, let's say, 41.53, but you would make the profit from 41.46 to $41 and also the premium that you've collected. Now, you are capped at the max profit that you can make because, well, the stock, it will get called away from you at $41, and if it does, then you're not going to make any profit if it runs up to even $50. So, but here's a important part. At $38.49, that right there, the $38.49 is the break-even point. And what that means is, let's say at expiration the stock has traded down to $38.49. That is your break-even point because you've collected a premium on the call that you have sold. So, and this is why this strategy is attractive to a lot of traders of doing these types of strategies with covered calls, because even if the stock trades down a little bit, it doesn't get called away from you. You collect a premium, but also you're at a break-even point of $38.49. And then what you can do is go out and write another covered call on the same stock. As long as you own the stock, you can keep writing the calls on it. Now, you have to own at least 100 shares to sell one call contract. And there's one thing I want to go over, and that is naked call selling. Naked call selling is very dangerous. And the reason for that is, let's say you did not own 100 shares, but you went and you sold one call contract. You sell one call contract at, let's say, on stock XYZ, and you did it at a 50 strike price, but you don't own 100 shares. Now that stock trades up to, let's say it had earnings and it traded up to $55. Well, now that stock, if it got called away from you, you don't own 100 shares, but now you're obligated to go out and purchase 100 shares at the time what it's trading at. Now, if it's trading at $55, you would have to go out and buy 100 shares at $55 and then turn around and sell it to the individual that exercised his right to call the 100 shares from you. That is what's called naked call selling. It's very dangerous, and some brokers will not even allow it. And before you actually do any type of real world training, I would highly recommend to go ahead and do some paper trading. And also, when you are ready, I recommend to talk with a licensed financial advisor. This type of strategy, when you do it on stocks that you own, that you feel comfortable with, it's a very profitable strategy for a monthly income, and I currently do it. I do like the strategy. I do a lot of other types of strategies that I'm going to go over in the future. I do a lot of swing trading, and I do a little bit of option strategies. I might do some iron condors. I'll do a lot of calendar spreads, And in the future, I'm going to go over some of those well and explain how to do that type of option strategies. So until next time, have a great day.